Okay, welcome to this high-yield whiteboard explainer. Today, we're bridging that gap between just doing basic data entry and actually delivering high-level financial evaluation. The goal? Securing that A-star in IGCSE Accounting 0452. So grab your calculators and some scrap paper right now because this isn't just about recording numbers, we're building real financial intelligence. We're going to treat this session like a totally interactive whiteboard workshop, so definitely get ready to work along with me. Let's get into it. Here's our quick agenda for today. 1. Core principles. 2. Technical execution. 3. Ratios and evaluation. And finally, 4. Examiner's secrets.
All right, starting with Section 1, Core Principles and the 2026 Blueprint.
Let's kick off with our concept recap. So, for the 2026 exams, Cambridge has entirely transitioned to modern international terminology. Listen, if the exam uses the command word state and asks for the correct term for an unpaid written-off customer balance, you absolutely cannot use bad debts loosely anymore. No way! You must write irrecoverable debts with 100% accuracy. The exact same rule applies to replacing capital with owner's equity. Why the change? Well, it ensures total financial transparency for all those stakeholders making massive annual decisions. Banks assessing loan applications, owners reviewing returns, or tax authorities auditing compliance.
Now, underpinning all of this is the business entity concept, and of course, the accounting equation, assets equal liabilities plus equity. The absolute crucial takeaway here is that you have to maintain this duality at all times. Every single transaction has a dual effect. It's like a perfectly balanced scale. Buy a delivery van for cash? Well, your non-current assets go up, but your current assets drop by the exact same amount. The equation stays perfectly intact. If this equation doesn't balance at the end of your financial year, your whole foundation is cracked, and trust me, your trial balance will immediately expose that error.
Moving on to a major trap you really need to avoid: violating the prudence concept. Basically, prudence means we never overstate our assets or profits, and we literally never ignore potential losses. So, if an exam question asks you to advise a manager who, let's say, wants to artificially inflate profits by just ignoring a highly likely customer default, you've got to step up. You must cite the prudence and historical cost concepts as your absolute defense against it. You anticipate that loss, record it, and protect the integrity of the statements.
Beyond prudence, securing that A-star genuinely requires an elite analytical vocabulary. I'm talking about terms like accrued, prepaid, realization, and consistency. And here's the kicker. You can't just memorize textbook definitions for these words. You've got to be ready to explain and apply them to those complex, multi-layered business scenarios waiting for you in Paper 2. Like, knowing the definition of consistency is fine, sure, but applying it to explain exactly why a business can't just magically switch depreciation methods every single year to manipulate their bottom line? Yeah, that is exactly what gets you the top marks.
Okay, moving right along to Section 2, Technical Execution and securing those precious method marks. To actually secure those marks, you really need to master the procedural flow. Let's walk through an execution. Say the exam prompt tells you to prepare the books of prime entry. First things first, you have to identify the correct source document. Imagine receiving a credit note for a sales return. You spot it, and from there, you log it straight into the sales returns journal. Then you seamlessly transition that data into your T-account ledgers using your double entry rules. At month end, you extract those balances to prepare your trial balance, and finally, you draft the income statement and statement of financial position. But watch out. Missing just one step, like failing to record that initial credit note, completely derails the entire flow and cascades errors through the whole financial year.
Now, here is a massive, game-changing secret for exam success. Method marks are awarded even if your final balance is completely wrong. Yes, you heard that right. This means you absolutely unequivocally must show all your workings. If a question asks you to calculate the revised inventory valuation, write down your original cost, clearly subtract the net realizable value right there on the paper and show the difference. Even if your final addition goes completely sideways under the stress of the exam hall, the examiners will reward your logical flow. But, and it's a big but, only if it's written down. Never ever do complex mental math without putting the steps on the page. Show the examiner your brain.
Let's take a look at the T-account structure real quick. This is the absolute gold standard for the double entry system. You've got to master the art of balancing these accounts at month end. You need to carefully distinguish between your balance carried down to close the period and your balance brought down to open the next one. Mixing up a debit balance brought down with a credit balance, oof, it destroys the continuity of your ledgers and sends errors crashing straight into your trial balance. Think about it. A debit balance brought down means it's an asset or an expense. If you accidentally throw that on the credit side, you've just told the examiner it's a liability. Precision here is literally everything. And speaking of precision, a truly heartbreaking mathematical pitfall in this execution phase is miscalculating percentages between trade discounts and cash discounts. Honestly, it's the easiest way to just throw marks out the window. Let's say you're looking at a $1,000 invoice. The golden rule is calculate the trade discount first. Let's deduct a 10% trade discount, leaving us with $900. Right. Only then do you apply the cash discount to that new total of $900. You've got to double-check your math every single time here, because one little calculator slip ruins the rest of the question. Oh, and while we're talking about being precise, never forget how incredibly vital it is to include your correct currency symbols when drafting manufacturing accounts. A number without a currency symbol is just a naked number. It's not accounting data.
All right, let's shift gears to Section 3, Ratios and Evaluation, also known as the AO3 Interactive Challenge. Okay, time for your interactive whiteboard challenge. Grab that pen I mentioned earlier. Imagine you're asked to evaluate a business's current ratio. Last year, they were sitting super comfortably at 2.5 to 1. That means they had $2.50 in liquid assets for every single dollar of short-term debt. Awesome, right? But this year, their liquidity has plummeted. It crashed drastically down to 1.1 to 1, meaning they are barely covering their immediate liabilities.
So I want you to physically pause this explainer right now and evaluate this. Seriously, write down 3 reasons on your whiteboard or scrap paper. What on earth could have gone wrong with their liquidity to cause such a massive drop? What high-level business decisions led to this exact ratio? Don't just stare at the numbers. Think about the real-world actions of the managers running the place. Take a moment, think it through, and hit play when you've got your answers.
Okay, let's see how you did. If the exam asked you to suggest reasons for this plunge, here are the high-level analytical answers that actually score those assessment objective 3 marks. Perhaps the business over-purchased inventory, totally tying up all their liquidity in stock that just isn't moving. They've got a warehouse full of goods but absolutely no cash. Or maybe they paid their trade payables way too quickly, stripping their cash reserves unnecessarily before the actual deadline. Or, and this is a big one, perhaps they completely drained their cash reserves on a massive capital expenditure. Think buying a brand new warehouse outright with cash instead of just taking out a loan. This right here, this is the exact level of interpretation examiners demand when you evaluate ratios.
Now, you'll also frequently be asked to compare 2 different businesses. But tread carefully here, guys. Differing accounting policies make direct comparisons an absolute minefield. For example, if Firm A uses straight-line depreciation for their vehicles and Firm B uses the reducing balance method, their profit figures are fundamentally shaped by those differing policies. In year 1, Firm B is naturally going to show much higher expenses and a lower profit simply because of the math, not necessarily because they're a worse business. You have to state this limitation in your evaluation to hit that top band of marks. You simply cannot take profit figures at face value without digging into the underlying policies.
Finally, to truly evaluate return on capital employed, or ROCE, you have to look beyond the surface numbers. The numbers tell you what happened, sure, but they rarely tell you why. You have to analyze the actual quality of the profit by looking at non-financial factors. We're talking about things like plummeting staff morale, an outdated business location, or a really damaged market reputation. These things are completely invisible in the ledgers, but they are absolutely vital for long-term sustainability. A company might post a fantastic ROCE this year just because they slashed all their training budgets, but trust me, that resulting poor staff morale, it will absolutely destroy their profits next year.
And that brings us to our final part, Section 4, Insider Examiner Secrets.
Take a look at this incredibly simple yet totally devastating mistake straight from the recent principal examiner reports. They explicitly noted that students often lose marks purely through poor handwriting. Can you imagine? You dedicate hours to understanding all these complex policies, you totally nail your calculations, only to lose your A star because the examiner literally couldn't read your time-pressured ledger entries. Keep your numbers legible. If your 0 looks like a 6, or your columns are so messy that the addition is impossible to follow, the examiner literally cannot award you those method marks we talked about earlier. Another massive glaring warning from the recent reports is the failure to accurately classify between revenue items and capital items. Mixing up a day-to-day running expense, like repairing an existing machine, with a long-term capital purchase, like buying a brand new crane, will completely warp your income statement and overstate your assets. If you classify a repair as a capital item, suddenly your profit looks artificially high and your assets look way more valuable than they actually are. You must strictly categorize them. Always remember the golden rule. Capital expenditure creates an asset, while revenue expenditure just maintains it.
The examiners also heavily emphasize time management during the actual exam. Balancing your time according to the marks available is just as critical as knowing your accounting policies inside out. Please, don't spend 20 minutes perfectly drawing lines with a ruler for a tiny 5-mark question while leaving a massive 15-mark evaluate question completely blank because you ran out of time. Respect the weightage of the paper. As a rule of thumb, a mark is usually worth about 1.5 minutes of your time. Stick to that ratio rigorously.
So, as we wrap up this explainer, I'll leave you with this final, provocative thought to carry into your next mock exam. Knowing that method marks are absolutely king, will you prioritize showing your complete, clear accounting logic over just desperately hunting for the final answer? Are you truly ready to secure every possible point by making your thinking visible to the examiner? Think about it. Take these principles back to your whiteboard, practice those command words, and I'll see you in the next explainer.